Welcome to The Explainer. Today, we're breaking down how companies decide if a multi-million-dollar idea is a brilliant investment or a potential financial black hole. We're going to show you how to go from a simple guess to a near guarantee using the tools of financial analysis. So let's say you have this amazing, game-changing idea, but it needs a serious amount of cash to get off the ground. How do you convince yourself or your boss or a whole team of investors that it's actually worth the risk? How do you prove it's going to pay off? All right, let's dive in. We're going to build this up step by step. We'll start with the most basic question you can ask, look at a really quick but kind of flawed method, and then work our way up to the really powerful tools that finance pros use to make these massive decisions every single day. Every single project analysis, and I mean no matter how complicated it gets, it always starts with three core numbers: what you spend to build it, what you spend to run it, and what you earn from it. It's really as simple as that. So for our running example today, let's just imagine a project with these numbers. The initial investment, what we call CapEx, is 100,000 reais. The yearly operating costs, or OPEX, are 20,000. And it brings in about 60,000 in revenue each year. So you do the math, that leaves us with a nice, clean net profit of 40,000 reais per year. Okay, so you're making a 40,000 profit every single year. The most intuitive, the most obvious way to look at this is to ask a really simple question. How long until we get our initial 100,000 back? And this timeline here shows that journey perfectly. We start 100K in the hole. After year 1, we make 40K back, so we're only down 60. After year 2, we're just down 20K. And then, exactly halfway through that third year, boom, we cross the zero line. That 2.5-year mark, that is our simple payback period. 2.5 years. I mean, on the surface, that sounds pretty good, right? In fact, a lot of companies specifically look for projects with payback times under 3 years. But this simple calculation, as clean as it looks, is ignoring a fundamental, unshakable law of finance. And this brings us to a really crucial point. Money today is just not the same as money tomorrow. Time itself actually changes its value. Let me ask you this. It's pretty simple. Would you rather have 100 reais today or 100 reais 10 years from now? Well, of course you take it today. Why? Because you could invest it, you could earn interest on it, and you could turn it into way more over that decade. Money you have to wait for is always, always worth less. And this core idea, it has a name. It's called the time value of money. It basically means that the 40,000 reais profit our little project makes way out in year 10 is simply not as valuable as 40,000 reais in our pocket right now. And our simple payback calculation, it completely ignored this. So to account for this wrinkle in time, we need a much better tool. And this is where the pros turn to something called net present value, or NPV for short. What NPV does is it discounts each of those future profits back to what they're actually worth in today's money. We use something called a discount rate, let's say 10%, which represents what we could have earned somewhere else. And just look at the table. That 40,000 from year 1 is only worth about 36,000 today, and by the time you get to year 10, it's only worth 15,400. That's a huge difference. Okay, now here's the powerful part. We add up the present value of all 10 years of profit. Then, and this is the key part, we subtract our initial $100,000 investment. The final result, that number right there, is the net present value. That is the project's true value in today's money. And this leads to an incredibly simple, powerful decision rule. If the net present value is greater than 0, the project is a go. It means that even after accounting for the time value of money, this investment creates real, tangible value for the company. It's a winner. So NPV tells us the project is profitable, which is great news. But what is its actual rate of return? You know, if this project were a savings account, what interest rate would it be paying us every year? For that, we turn to another key metric. And this is the internal rate of return, or IRR. The easiest way to think of it is as the project's own personal break-even interest rate. It's the exact discount rate that would make the NPV equal to exactly 0. It tells you the inherent year-over-year rate of return that's just baked right into the project's cash flows. For our example project, the IRR is a massive 38%. Now, every company has what's called a hurdle rate, a minimum acceptable rate of return, which is often around 10%. Since our project's 38% IRR absolutely crushes that minimum, well, it's not just viable, it's a highly attractive investment. Okay, so we've got the concepts down. Now let's put this all together and see how these incredible tools apply to a much larger, way more complex industrial project, one with a lot more variables in the mix. See, a real-world analysis, like for a new factory, adds a few more layers. You have to account for construction time before you earn a single penny. You factor in things like depreciation, which is basically your equipment losing value, because it gives you some really valuable tax benefits. You have to add in costs like land and working capital. But even though it's more complex, the engine driving the whole decision is still NPV and IRR. So, after running all those numbers for our hypothetical 100 million reais industrial plant, here is the first key result. The net present value is a massive 61.3 million reais. That means the project is expected to generate over 60 million in pure value in today's money. And what about its rate of return? Well, the IRR clocks in at 22.1%. Remember that hurdle rate we talked about? This number sails right over a typical 10 or 12% minimum, which is another powerful signal that this project is a financial winner. And finally, we look at the payback, but this time adjusted for the time value of money. The discounted payback period is 4.9 years. And for a major industrial plant, paying for itself in under 5 years is an excellent result. So you've got a positive NPV, a high IRR, and a strong payback. All signs point to yes. This project is getting the green light. So, as you can see, using tools like NPV and IRR gives us a much truer picture of an investment's value. It really does turn a guess into a near guarantee. But you have to remember, this powerful analysis is built entirely on assumptions about the future. And that leads to one final critical question. What single wrong assumption could make this entire project fail?